Hey there YouTube. So in this video I wanted to cover IRS form 4684. This is to report casualties and theft losses that you can take as a deduction on your tax return. So you're going to generally be filing this if you're an individual taxpayer and you have either personal property, like let's say a car for example, or a piece of real estate that's either a second home or your primary home that was completely damaged or significantly damaged in what the federal government would consider a federally declared disaster, right? So these are things like hurricanes, wildfires, earthquakes, flooding. If the federal government, and specifically FEMA, designates the area and the event as a federally declared disaster, then you can take a casualty loss deduction for the amount of your loss that wasn't covered by insurance. So in this example here, we have John, taxpayer. He's an individual, lives in Florida. And so John had his vehicle destroyed during one of the hurricanes. And so insurance didn't cover everything, so he wants to write off part of the loss on his taxes. So in order to do that, he needs to fill out this form and attach it to his 1040. At the top here, the first thing that he needs to do is look up what the federally declared disaster was, right? So check here. And then you can go to the FEMA website and actually look up the disaster and get the EM or the DR, the declaration number. So if we go to the FEMA website here, and there's a link to this page within the form instructions. So if you're looking at the form instructions, there's a nice little hyperlink that goes right here. But we're on the FEMA site, declared disasters. So John is a resident of Florida, so he's looking up Florida disasters for the 2020 tax year. And he searches for these, and he gets a nice little list here of a bunch of declared disasters in Florida. So get COVID, swamp fires, bayou fires, and a couple of hurricanes, Sally. The one that destroyed his car was Florida Hurricane Ida, right? So Florida Hurricane Ida, this is the information he's after. Now this site has some information on the disaster, the incident period, and then it also has a map of the state, and it'll show what counties were impacted by the disaster. So what he's after here is the EM number, so EM 3551. And he can enter that here, right? EM 3551. Even though it has a Florida tag at the end here, you leave that off, right? The disaster declaration number is just 4 digits. So 3551 is what he's after. And then in section 1 here is where we start, filling out information on the property and the loss. So what he had destroyed again was his vehicle. He had a 2015 Honda. The address where the vehicle was basically parked when it was destroyed, so that's his home address, and then the date he bought the property initially. So he bought it in 2015. He's had it for a couple of years. So now we have some financial information on the property. So he paid $20,000 for it back in 2015, and the insurance he had only covered up to $5,000, right? So he got a $5,000 check from the insurance company. In his estimation, the vehicle was worth $12,000, right? So it was worth $12,000 right before it was destroyed by the hurricane. So his net loss is in effect $7,000, right? That's how you arrive at this number. He had a $12,000 car, only got $5,000 back for insurance, so $7,000 is his loss. And so we go down the rest of the form here. $7,000 loss, $100 comes off the top. This is just kind of the way that they compute your net casualty loss. So $6,900, and then there is an AGI limitation, right? So on line 17 here, it's going to ask you enter 10% of your AGI, and so this is kind of effectively be kind of another deduction against whatever your total loss. So the higher your income is, the greater the amount of loss you can deduct. So in this case, if we go back to John's page 1 of his 1040, his AGI here on line 11 is $44,500. So that's the amount of income he made during the year. So a 10% limitation on that is $4,450. And so this is his net casualty loss, $2,450. So the $2,450 item is reported on Schedule A as an itemized deduction. So here we have John's Schedule A. He's got taxes here for real estate taxes. He's paid mortgage interest on his property. some charitable gifts, and then right here in this section, line 15, we have the casualty and theft loss. So that's the $2,450. So his total itemized deductions for the year are $13,263. Now, what's unfortunate about this is if you do not itemize deductions, then the casualty and theft loss just really is going to be a moot issue, right? So if John just took the $12,000 standard deduction because he didn't have all these other itemized deductions, he might not actually be able to use the casualty or theft loss. So before you go, completing this form, look at whether you're going to take a standard deduction or the itemized deductions, because if you're not itemizing, then this number is going to have to be quite large in order to derive any kind of benefit out of it. Otherwise, you're just taking the standard deduction. So that covers it for this form. Hope that was helpful for you. If you have any questions, please leave me a comment below in the video. Happy to answer those, and I look forward to seeing you again soon. Thank you.